a very prominent market voice, Mark Matthews of Bank Julius Baer, with us right now on the show. And Mark, so good having you. Thank you so much for joining us on Bloomberg Quint yet again. It's always a pleasure having you. Frankly, the reason for seeking your opinion today was very simple. Thus far, Indian markets have been under a cloud of higher crude prices and worsening macro. The last 15 days have seen the reversal of sorts, with crude correcting sharply and the rupee appreciating as well. But now we have the boogie of the global market starting to correct. How do you think a market like India behaves in such a scenario, or maybe emerging markets behave in such a scenario?
Well, I think you set it up very nicely, and by the way, I'm honored to be here. And I have no crystal ball, but I can just tell you that I do think the big question revolves around interest rates, and they will determine where the U.S. market goes, and in turn where the dollar goes, and therefore most of the rest of the world. And for that, it's very difficult to say, because on the one hand, you do have this severe correction in U.S. share prices, which the Fed, at least some of the Fed officials, must be worried that they are going to be blamed for this. So we won't be surprised by a December meeting hike when that comes, but the wordage coming out of the December meeting will be very closely watched, and of course all the wordage up to it, to see if anybody in the Fed is going to become a little less hawkish. And when we look at the dot plot, there seems to be a big division within the Fed about how many times to raise interest rates next year. Some people say 2, some people say 4. And the street, there's a similar divergence. So the answer to the question, I think, is primarily around rates. And I would just say that our house view is that the Fed ultimately will respond less to political pressure, more to the economy. The U.S. economy is strong. We're still looking for 1 rate hike this year and another 4 next year, which means a stronger dollar, which means that although we have seen a very nice rally in emerging markets, including India, it's difficult to say that it has a lot of legs, given what I just told you.
Okay. So let's try and set up this picture. And I want to pull up a chart which was used in the morning as well on Bloomberg Quint. And that's the difference between the spreads between the U.S. Treasury yields versus what the corporate credit returns are, or the yields are as well, rates are as well. And that's widened to almost 2-year highs. Mark, about 4 months ago, almost everybody believed that maybe, just maybe, the Fed is underestimating the pace at which it would have to hike rates. Now, there are murmurs of there being an outside chance that the Fed might itself not go as briskly as it would because of the belief around the credit cycle too. Couple that with the fall in crude, which has a big macro impact on a market like India. Do you think bears might be underestimating the pace at which reversals could come into select markets?
Well, I think yes, and I think once again you've set up this question wonderfully, because it's true that even Jerome Powell said last week that he does, among other things, look at markets, and the market he's looking at the most now is the credit market. You have had a big rise in the spread of corporate bond yields over treasuries. I might add, however, nowhere near the kind of rise that we saw in the financial crisis 10 years ago, in the Greek crisis, even in 2015. So yes, they're rising. I don't think they're really rising to levels that signal a lot of caution. But if they continue to rise at this pace, we'll get there. So then the other point you rightly touch on is that oil price coming down could take some of the, how should I say, the worries away that the inflation rate will continue to advance up a lot. But ultimately, as much as the oil price and commodities are an important factor in inflation in the United States, another equally, if not more important factor is wage growth. And if you look at where the unemployment rate is and the pace of job creation, I think we should expect further wage growth, and that, I believe, would would mean the Fed can't really ease off on its worries about inflation just yet.
All right. Mark, good afternoon to you. You've highlighted the possibility of the strength in the dollar, which could curtail the excitement or the exuberance in emerging market equities and the follow-up in case we do see a good run-up from here on. What does this do for currencies thereof? Because once again, while earlier on we've been looking at our markets and talking about the Indian rupee versus the dollar weakening to levels of about 74, 75, it's come off very sharply from there. It's strengthened quite a bit. But whether or not, the constant strength in the dollar questions that as well.
Well, yes, it would. I mean, I think the rupee obviously is trading against the dollar, and so if the dollar continues to go up, the rupee will go down. I also really wonder if the oil price is going to continue to go down much further than where it is now. I mean, it's unprecedented that you get such a big loss in such a short period of time. But I guess relating to the currencies, I might just throw into the conversation Europe, because the euro is about 2/3 of the dollar index. And so we've got an important day today and tomorrow where the European Union will have to respond to Italy's budget. And what I'm just hearing this afternoon is, in fact, the Italians might be taking a step back on being so confrontational, which of course would be good for the euro and bad for the dollar. But we also have Theresa May meeting with Jean-Claude Juncker and some of the other big shots in the European Union today. And Brexit, I think, also remains a big thing, because the pound and the euro tend to trade in sync relative to dollar. So if you get more Brexit concerns mounting, then I don't think you should expect dollar weakness, put it that way. And I don't see the solution at hand in the Brexit situation. It's a very complex one, but as it stands now, the agreement that the Europeans want the British to accept basically keeps the British in the European Trade Union in perpetuity, and that's never going to fly as far as Parliament in the UK goes.
Mark, in light, if at all we do see the Indian rupee worsen from here on in regards to the dollar's strength, and for us as well, yields start to move higher, would the risk reward, I mean from a foreign investor, from a perspective of a foreign investor, lie more favorably in the bond market rather than the equity market?
Well, I think that the bond market in India has probably more value, if you just speak in broad terms, where it is priced now relative to history. The equity market is cheapened, but earnings have been revised down, whereas in bonds, which you're primarily interested in, is getting paid your coupon and the health of the balance sheet. So net-net, I would agree with you that the bond market in India is more interesting than the equity market. But speaking of emerging markets, I mean, the thing is that their currencies were already so punished earlier this year that I think the asset class actually has probably bottomed out and will be gradually on the up and up over the next 12 months. Yeah, I would say that.
We've already seen a reflection of that in the month of November. Foreign money has been coming in, not just into the bond market, but in the equity markets as well. In the first half of November, almost more than $1 billion worth of funds have come into the Indian equity markets. Do you see that likely continuing? Do you see this as being favorable compared to if the interest rate tightening did progress at the pace at which the Fed anticipates it to progress? Then, that will be a better investment than coming back to India and investing in the equities here.
Yes, I've noticed as well the significant foreign inflows and also the larger inflows in the month of October from local funds. And I wish I could give you an answer, but I honestly don't know the nature of that money as far as it pertains to India, whether it's short or long term, how much more is behind it. I just can't say, but I would guess that it's more short-term in nature, given that we still have general elections 6 months in front of us, and the closer we get to that date, the more I would imagine people would want to hold back their investment in India until after the elections are over and done with.